Hey, alpha investors. We are all on a journey to build wealth and secure our financial future. But a crucial part of that journey is understanding the tools we use. Today, we're talking about two of the most popular and often confused investment vehicles out there: index funds and mutual funds. On the surface, they seem interchangeable. They both pool money from many investors to buy a variety of assets, giving you instant diversification, but their core philosophies couldn't be more different. This is a battle not just of numbers, but of principles. First, let's look at the mutual fund. Think of a mutual fund as a basketball team. You have a highly paid, professional coach, the fund manager, who spends all day, every day, studying the market. This coach picks the players they believe will win the game and constantly makes trades, trying to beat the competition. Their goal is not just to perform well, but to outperform the market. This is known as active management. The principle here is that human insight and expertise can consistently beat the average. They believe they can find undervalued stocks and sell overvalued ones. For this active management, you pay a higher price, often in the form of a higher expense ratio. Now, let's talk about the index fund. This is an entirely different philosophy. An index fund is not trying to beat the market. It's trying to be the market. It follows a principle of passive investing. Instead of a high-paid coach, you have a simple, elegant rulebook. This fund invests in all the players on a predefined roster, like the S&P 500. It holds all 500 companies in that index, in the same proportion. It doesn't care which ones are good or bad. It just holds them all. The core belief is this: over the long term, it is nearly impossible for a single person to consistently beat the market. Therefore, the most logical, most certain path to wealth is to simply own a slice of the entire market itself. This eliminates the need for expensive, active managers, which means the fees are incredibly low. We are talking about the difference between a high expense ratio and one that is often less than 0.1%. So, we have two opposing principles. The active principle, a belief that human expertise and constant action can create superior returns. The passive principle, a belief that the market, as a whole, is a more powerful and reliable engine for wealth creation over time. Now, which one is right for you? It's not a question of which one is better, but which one aligns with your core beliefs about investing. If you are a student of the market who believes in your ability to research and identify a truly great manager, and you are willing to pay for that expertise, then an actively managed mutual fund may be an option. You are betting on an individual's skill to deliver alpha or a return higher than the market. However, consider this sobering truth. Studies show that a staggering majority of actively managed funds fail to beat their benchmark index over the long run. In fact, many of the very people who created the funds now advocate for the low-cost, passive approach. The legendary founder of Vanguard, John Bogle, often said, "Don't look for the needle in the haystack. Just buy the haystack." If your goal is to simply participate in the long-term upward trend of the market without having to spend hours on research, analysis, and chasing returns, then an index fund is the wiser choice. It is a philosophy of humility and patience. You accept that you cannot time the market or pick the winners, but you have absolute faith in the engine of human innovation and progress that powers the entire economy. The choice is yours. Will you chase the needle or buy the haystack? The principles you choose to build your investment strategy on will ultimately define your success. If this video helped you understand the profound difference between these two investment principles, give it a like and share it with a friend. And if you want to continue your journey into online money making, hidden wisdom, and investing, hit that subscribe button and ring the bell so you don't miss our next video.